Hello and a very warm welcome to moneycontrol.com. Barely a month to go for the budget, and as part of our pre budget interviews, today we are speaking with Mr. Nilesh Shah, the Managing Director of Kotak Mahindra Asset Management. He, of course, wears many hats. Besides managing money and funds and equities and securities for a whole lot of people, he's also a member of the Prime Minister Economic Advisory Council. Mr. Shah, thank you very much. You're joining us all the way from Gandhinagar. Really appreciate the time. And you're in Gujarat, where the state has voted for the BJP for the seventh time. So, and we spoke before the Gujarat elections. You are an optimist about the Indian economy, about Gujarat. I just want to begin by asking you about what are the things that are exciting you right now about India?
So, once Shweta, thank you for having me over here. I think the whole story of India is in its cities, companies, and state. Today, 4 out of top 10 fastest commercial construction activities happening in the city of India: Delhi, Chennai, Hyderabad, Bangalore. 6 out of top 10 fastest growing cities for calendar year 2022 in the whole world are in India: Bombay, Delhi, Kolkata, Chennai, Bangalore, and Hyderabad. A company like Amul, which is India's largest FMCG company, are targeting that by 2047 they will be the world's biggest food company with 18 lakh crore turnover. And today's my state of Maharashtra is equivalent to India, which was in 2005. Today's Uttarakhand and Uttar Pradesh combined is equivalent to 2001 India in terms of GDP. And Gujarat, Tamil Nadu, and Karnataka are equivalent to 2000's India GDP. Effectively, today's few states like Maharashtra, Uttar Pradesh, and Uttarakhand, Gujarat, Tamil Nadu, Karnataka are equivalent to yesterday's India. And tomorrow's states will be equivalent to today's India. Together, and clearly we are at a scenario where our states are becoming as big as today's India in future. Our cities are fastest growing cities in the world. Our companies are aiming to be global number one. Put all these things together, that makes me bullish on India.
Okay, how are you reading into what we've seen in the equity markets? We've seen the equity markets booming despite the fact that there was a huge outflow of FPIs. So, is that optimism getting reflected in the equity markets as well?
Undoubtedly, FPI sold India between October 21 to June 22 to the extent of about $35 billion. They sold India because we were expensive. Historically, we have traded at about 40% premium to global averages. Today, we are trading at 80% plus premium. Second, here in India, FPIs had profit. We had delivered almost 3 to 4 times more return than our competitors. And third, and the most important, there was exit in India. You sold $35 billion of equity, you could take money out, and there was virtually no impact on market. So FPI sold because they had profit, because they had exit, and we were looking expensive. But now they are returning back. They are returning back because in the rest of the emerging market, there's no country comparable to India in terms of long-term growth potential. We were 10th largest economy in 2014. Today we are 5th. And anywhere between 2028 to 30, we will become third largest economy. So people are returning back from a growth point of view. And our equity markets are reflecting that optimism. Might I add that we are becoming a bit too optimistic. But then when your growth story is so good, that's bound to happen.
Right, Mr. Shah. I know that you are an optimist about the India growth story. If you were to summarize all the factors that have contributed into making the Indian markets as one of the best performing markets globally, what would they be?
I think there are only three factors: growth, green, and governance. Our earnings growth is superior to rest of the world, and more importantly, we can see a roadmap how a $3.5 trillion Indian economy will grow to become 10 trillion, 15 trillion, and $30 trillion economy over a long period of time. There are very few countries where you could see that kind of trajectory. The second thing is governance. Clearly, our governance standards are comparable to the best in the world. SEBI, Ministry of Finance, Company Law Board, all have now set up governance standards which are fairly superior to rest of the emerging market. And finally, our growth is also green. We are one of the few countries in the world who is focusing so much on climatic change, renewable energy, and so on and so forth. We are the only country which will achieve its Paris Accord target. So for FPIs, they are getting unbeatable combination of 3G, growth, governance, and green, and that's reflected into our market performance.
When you considering we are a month away, a little over a month away from the budget, what are the key concerns that you think that the budget should address? And considering it's the last one before the government goes in for elections, what are the red flags that you think they need to address?
So one, thanks to COVID, government had to incur higher spend and higher deficit. We had earlier announced a roadmap of fiscal responsibility and budget management act. That act has been put into abeyance. We need to give a glide path on our fiscal deficit. It is high today. We need to bring it down. Number two, the government has done extremely good work on building infrastructure. In many cases, like electrification of railway line, power capacity, highway construction, a major port cargo addition, in all this infrastructure space, we have done uh, between 2013 to 2022 or 24 what we had done in previous 67 years from 1947 to 2013. Now, this spending must continue. We have doubled our infrastructure spend in last 8 years. That trend should continue. And finally, uh, clearly, the funding of deficit should happen from innovation rather than raising of taxes. Our tax to GDP ratio has already improved from high single digit to low double digit. Tax compliance should improve, but not the tax burden. We need to fund our deficit through innovative means rather than through standard means.
Okay, can you tell us a little bit more about the innovative means that you're talking about? Are we looking at maybe expanding the tax net? Is that something that you think the government should be looking at?
So, in my opinion, government should be looking at three things to raise taxes. One, government of India should introduce exit tax. Today, in United States, if an American citizen surrenders its citizenship, they pay taxes on the market value of assets in America as well as outside world. Between 2017 to 2021, 9,30,000 Indians have surrendered their citizenship. Let's round them off to 1 million. If they have taken out just $50,000, that's an outflow of $50 billion. If you believe they will take out $250,000 over a period of time, that's an outflow of almost $250 billion. Clearly, we should be levying exit tax on those Indians who are surrendering their Indian citizenship, who are becoming citizen of other countries, and who are paying taxes over there. It's a matter of shock to me that an Indian citizen or an Indian who is now American citizen pays inheritance tax in America on assets which is given to him by his Indian parents in India. Now, clearly, we need to ensure that we should be collecting that tax rather than the American government. The second thing, Sweta, we must monetize locked assets. For example, we launched Custodian of Enemy Property Act in 1965, post 1965 war. We did it, and Pakistan also did it. Pakistan liquidated all enemy properties which they had acquired by 1971. We are in 2021. There are 7,000 plus properties valued at more than 1 lakh crore which are tied up under custodian of enemy property. We must liquidate those assets remove the encroachments and litigations, and fund our budget deficit with that locked assets. The third and the final suggestion will be gold disclosure scheme. Between 2000 to 2021, we have imported on a net basis $373 billion of gold. Now we must add gold smuggling and also gold which is returning by jewelers, by travelers walking through Green Channel. Collectively, would we have spent $500 billion in import of gold between 2001 to 2021? Quite likely. Now, some part of this gold is in white economy, major part is in black economy, locked into tijori, locked into bank lockers. Can we target between 5 to 10% of gold which is in black economy? If we can do that through a gold disclosure scheme, the tax collection estimates could be upwards of 2 lakh crore, and the capital which will be freed from black economy to white economy will be upwards of 6 lakh crore. So through exit tax, through monetization of custodian of NEB property, and through gold disclosure scheme, we should be able to raise anywhere between 3 lakh crore to 4 lakh crore, which can be used for funding your infrastructure investment and still keep deficit under check.
I'm not so sure whether Indians leaving India and settling abroad will like that suggestion, Mr. Shah. That's a very, very bold suggestion. It's somewhat similar to the wealth tax that was doing the rounds earlier, but then later, I think it was brought
So
in place.
Sweta, over here there is one advantage.
Hmm.
At least the Indians who are American green card holder or citizen, they do pay tax when they receive their parental assets. If they start paying tax in India, they'll get double tax credit over there. So we are just shifting, at least for American Indians, their tax burden from America to India. Now it is logical. Why should an Indian parent's assets going to their American son be taxed in America and not in India?
Yeah, that's a fair point. Fair point. American son, you didn't mention American daughter. Both, both children. In terms of when we look at the global economy, we're talking about global headwinds. We're talking about a very recessionary environment. Do you think the sense that one is getting is that India will manage to escape that freeze that that's going to be in across the world? India might actually just not get so adversely impacted by the recession. Uh, is that a view that you subscribe to as well?
So it's not that we don't have chinks in our armor. We have chinks in our armor and we need to tackle it. The first is private sector investment revival. We believe stars are now aligned after a gap of few years where investment revival could happen. Capacity utilization is above pre-COVID level. Balance sheets have deleveraged. There is demand for Indian goods in global market thanks to China plus one and Europe plus one. So private investment should revive. Government must do whatever it takes to facilitate the same. The PLI scheme is a good step in that direction. We must ensure that it gets executed on ground. The second thing which we have to take care is subduedness in consumption at the bottom of the pyramid. Clearly, the rich and upper middle class consumption is above pre COVID level, but lower middle income and the poor class probably has subdued consumption. We believe this Diwali's Dasera and festival season, consumption should have started become positive. We don't have data, evidence does suggest that consumption is turning positive. Now we must sustain it. The impact of inflation, the impact of COVID on poor and lower middle income has been hard. We must ensure that their consumption gets sustained in a positive territory. The third and the final thing for India is its trade deficit. We are running $100 billion more than what we can afford. We could fund it for a year or two because we have built up reserves. But we must bring trade deficit under control. If we can take care of bottom end consumption, if we can revive private sector investment, and if we can manage trade deficit, I have no doubt in my mind that we will be able to withstand global recession in a significantly better manner.
On the all the key points that you raised, they're extremely important points. Private investment has been subdued, consumption has been subdued. We are seeing a turn at the grassroots level. Rural economy is showing a little bit of a turn. Do you think there is right now there is a strong case for the government to put money in the hands of the people? Or do you think that the government should perhaps do an allocation or make an allocation on those lines as well?
Definitely. But instead of giving a fish to a person, we should be focusing on teaching them how to fish. That will sustain them for a long period of time. Now, in the COVID era, we introduced emergency line credit guarantee scheme that
Right.
provided about 3 lakh crore of credit to small and medium enterprises. That has worked out very well. It hasn't added to fiscal burden, but it has ensured that the MSME survived the downturn. Now, in India, there are so many bottom of the pyramid people who borrow money at 20%, 40%, 100%, 200% rate of interest. I did a survey in my area where vegetable vendors were borrowing at 100% per day. So they'll take 500 rupee in the morning and return 1000 rupee in the evening. It's 100% per day. Now, can we create a credit guarantee scheme for this bottom of pyramid through microfinance institution, through Jandan account borrower, investor, bank, Jandan account holders, so that they can get access to credit at a much cheaper rate? I think in this budget we should provide credit guarantee scheme for bottom of the pyramid through microfinance institution or otherwise.
Okay. Is there scope or is there room for an urban Manrega kind of scheme as well, according to you?
See, Manrega by and large is giving a fish to a person. We are using Manrega funds to create infrastructure in rural area, but it is by and large, salaries and wages cost rather than infrastructure cost. While it is necessary in the short to medium term, over a longer term, can we make this bottom of the pyramid people entrepreneurs by providing concessional funding? Now, imagine a vegetable vendor who is today paying almost 100% per day, getting access to finance at 12% per year. His profitability will improve and his ability to scale up business will improve. The biggest challenge for bottom of the pyramid is access to organized financing. They are still borrowing money from money lenders and Sharafi and those kind of unorganized sector.
Mhm.
Credit guarantee scheme is probably like teaching fishing to the bottom of the pyramid rather than giving fish like Manrega.
Okay, so you're not for that. Um, when we look beyond 2024, do you think this budget should set the tone for the next decade, or or should they be taking more incremental steps and follow the incremental strategy that they have been following so far?
So ideally, Shweta, you would love a batsman to hit fours and sixes. That's more entertaining, but then that's risky too. A good batsman is one which plays ball as per its merit, keeping in mind the strike rate necessary or scoring rate needed. We should leave it to the policymakers as to which ball they want to hit out of the park and which ball they just want to defend or just take one run. Now, clearly, there are some opportunities where I believe we should be aiming to hit 4 and 6 rather than taking one run. China plus one is such scheme, such opportunity. In 1980, India and China were of similar per capita GDP. Today, they are 6 times bigger than us because they become manufacturer to the world. In certain categories like generic pharma, two-wheelers, we are as competitive or better than China. Can we replicate that across many other products so that we can become alternative to China, so that we can become part of global supply chain management? India today is prospering or growing because it is back office to the world, because it is generic pharmacy to the world. But To sustain this growth forward, we also need to become manufacturer to the world. So at least on China plus one, let's go for fours and six, not just one or two, and that's not good enough.
Okay, I want to stay on the China point, considering the tension that we're seeing on our borders right now. The anti China sentiment is rising again. And if you look at the kind of Chinese investments that have been in the country, you look at our trade data, you look at the amount we are importing from China. Uh, in your view, what should India do to build on this China plus sentiment that we're seeing in the world and this whole import substitution that India had embarked on? Do you think that there is room to improvise on that?
Undoubtedly, China is a very, very competitive nation, and they have become manufacturer to the world. And despite anti-China sentiment all over the world, trade deficit with China has kept on increasing. Very recently, one European multinational company announced a $25 billion investment in China because they provided 12-month operational plan and also access to cheaper energy sources from Russia. Now, we won't be able to import gas from Russia, but can we provide a guideline, a red carpet treatment that in 12 months your plant will become operational? These are the big fishes which we must catch rather than letting them go to China. A red carpet treatment, a kind of Sanan model, if I can call it, is
We keep losing Mr. Shah. Right.
to set up
Yeah.
their factory.
Sorry, Mr. Shah, you'll have to just go back a little bit again. You said we need a red carpet, and that's when we lost you. Can you just repeat that?
Sorry. So we need to lay a red carpet for global investors. Sorry, I'm using someone's device, and that's why this connection, this
No, no,
disconnection.
that's okay. That's okay.
We need to
Very
lay a red carpet treatment for global investors. I can call it Sardan model. If you remember when Tata Motors was moving away from Singur after struggling over there to establish their nano factory, a Suswagatam message went to Mr. Tata. They were given land, they were given environmental clearance, they were given power connection, they were given all the facility to set up their factory. They were provided with connectivity and infrastructure. In 18 months, Nano started rolling out of Tata factory. If we can replicate Sanand model all over the country for global investors, then we will be as competitive as China in terms of welcoming foreign investors. If we become part of global supply chain management, then automatically we'll become manufacturer to the world. And that's where our growth will happen.
Mr. Shah, you keep interacting with foreign investors. What's the sentiment that you're picking up when they are looking at India as an investment destination? What are the key concerns that they're raising? Is the anti-China sentiment very palpable amongst the foreign investors?
So, global investors today are looking for fast track approvals. Certainly, many other countries like Vietnam, like China, like Southeast Asian nations are ahead of us. Global investors are also looking at rule of law. If you notice, most of the global companies prefer arbitration in Singapore and London rather than in Mumbai or Delhi. We need to clearly establish rule of law to attract global investors. And finally, it is ease of doing business. While the intentions of every government, be it central level, state level, local level, is to improve ease of doing business, is that dictate executed on ground? Whether it's infrastructure issues or whether it is clearance and approvals, can we do fast tracking? In Telangana, I believe there is now a law which says that if you apply for something and you don't hear from the government or authorities up to a period, then it is deemed that you have received approval. Something like that should be executed all over India, where we do fast track approval, we improve ease of doing business.
Okay. This import substitution scheme that the government had launched so that we reduce our imports from the rest of the world, do you think that's working? Considering that you mentioned the trade deficit is a big concern. I want you to talk a little bit about the import substitution scheme and maybe the government needs to introduce some more incentives to encourage exports rather than bring out rather than being protectionist?
So in mobile phone, we have been quite successful. In 2014, about 90 odd percent of mobiles were imported. Today, 90 odd percent is manufactured in India. From spending about $3 to $7 billion a year for import of mobile phones, now we have started earning $3 billion in exports. But what we succeeded in mobile phones needs to be replicated across many other sectors, across many other products. We are one of the largest grower of cotton in the world. We are one of the largest spinner in the world. We have been weaving fabric since Harappa Mohenjo-daro days. But from when it comes to converting fabric to the garment and extracting value, we are quite failure. A country like Bangladesh has 3 times more garment export than India. So what we did with mobile phone, we need to do it in many other products from automobiles, auto components, soft toys, garments, and so on and so forth.
Okay, that's a tall agenda. We are coming to towards the end of this conversation. I want to ask you, what are the sectors that you are betting on in your money manager role?
So right now we are fairly bullish on infrastructure. We believe pre-election mode government will spend allocation to infrastructure. Government will increase allocation to infrastructure, and infrastructure companies will benefit from higher order book and higher volume. We are also fairly bullish on banking and financial services. A lot of run up has already happened, so they won't be here multi-bagger from here, but they will still be compounding at a good pace. But one thing from a sectoral point of view, you need to be invested into the good management. A bad management in a good sector is not going to give you return. A bad management in bad sector is also not going to give you return. So our aim is to invest in good manager in a good sector.
Okay, again, that's something that's not easy for everyone to do. How does one know what company has good management? What are the things that you look for, or what are the red flags that one needs to watch out for? This is for retail investors. This question.
So to most retail investor, I just say one thing: कि when you try to find a groom or bride for your kids, you do apply some sort of analysis for finding out a good person. You take reference, you observe them, you try to go through an intermediary, but you put effort to figure out whether the other person is worthy of marrying your daughter or son or not. The same logic, the same due diligence, the same discipline is required when you go and invest money. When you go and invest money, check about the promoter, check about their past performance, past track record, try to observe them. You will get a good feel whether this promoter is worthy of your money or not. Just like by and large people get good feel about getting a bride or groom for their kids.
Okay, what's your outlook, Mr. Shah, for 23-24?
So economy will do well, but markets are discounting lot of positive things. So markets will go up and down, and like 2022-23, where equity funds return is almost comparable to debt fund return, maybe 2023-24 will be similar. On a 1 year basis, equity market may not deliver great return. Maybe there will be very narrow difference vis-a-vis debt fund. So please try to invest in a longer term basis rather than a shorter term basis. This is a market which is buy on dip market, but for longer term.
Okay, in terms of growth estimates, Mr. Shah, do we see growth petering down further before it picks up again?
A lot of our growth outlook will depend upon how global factors pan out. If energy prices continue to remain soft, undoubtedly our growth will pick up. If global inflation does come under control, our growth will pick up. But on the other hand, like way the central bankers around the world are today talking about controlling inflation and keeping rates higher for longer, then our growth could become subdued. So what happens globally will not be in our control. But if we focus on private sector investment revival, bottom of the pyramid consumption, and managing trade deficit, to a great extent, we will be able to de-link ourselves from global growth forecast.
Okay, so it's a catch-22 situation because private investment is dependent on consumption and consumption is dependent on incomes, opportunities, jobs. So do we see that going up? Do we see growth spurring economic activity on ground and creating more jobs, generating more incomes? What's your bet? Manufacturing versus services, or do you think both are going to be key drivers of the economy?
So you can't run a car on just one wheel. If you are going to focus on services and not on manufacturing, the car will not run. We have no option but to push both manufacturing and services. We have no option but to push both government investment and private sector investment. We have no option but to support growth with domestic savings as well as global savings. So it's not either or, it is end. Now, from a growth point of view, the challenge is skill. Today there are jobs for which there are many demand but not much of supply. That's because there is a skill gap. We are producing graduates, we are producing students, but they are not necessarily employable. How do we bridge this skill gap is the most important thing. If we can bridge this skill gap, then undoubtedly growth will create far more employment.
Okay. All right. Is there a New Year message that you would like to close this conversation with for the investor community, for the people of India, and for the government?
Economy will do well, but markets, you have to be careful. It's a buy on dip market for long term. When you are investing in equity, take a 5 year view, not a 1 year view.
Okay. All right. Thank you so much for that valuable advice and a very happy New Year, Mr. Shah. We hope to see more of you on Money Control in the new year. Thank you very much.
Thank you.
Pleasure talking to you.